You felt it, didn't you? The price of your everyday essentials, coffee, sneakers, smartphones, just jumped. Again. And this time, it's not inflation's usual creep. It's something bigger, more targeted, more deliberate, because China just slammed the brakes. On us, on imports, on trade. And if you think it's just politics, it's about to get personal. The 34% tariff wasn't a warning shot. It was a precision strike. On soybeans, semiconductors, and American livelihoods. But it's what comes next that might break the system. Export bans, blacklists, U.S. Treasury sell-offs, and it's already hitting your wallet. That MacBook? Expect delays. That electric car? Battery supply just got disrupted. And the burger on your plate? Welcome to beef prices we haven't seen since the pandemic. But if you think that's the whole story, wait until you hear why Beijing's not just targeting goods, it's targeting the entire Western economic model. So, what's behind China's full-throttle retaliation? And who's about to lose more, America's middle class or China's global reputation? Stick with me. Your grocery bill is about to become a political statement. On March 27th, China imposed retaliatory tariffs of up to 34% on $38 billion worth of U.S. goods, including beef, corn, and LNG, according to Bloomberg. Combine that with Trump's reimposed tariffs on $200 billion in Chinese imports, ranging from solar panels to microchips, and you're looking at a perfect storm for American households. Oxford Economics now projects core inflation could jump 1.1% in the second quarter of 2025 due to dual tariff shocks, with low-income families bearing the brunt. And it's not just prices. The American Apparel and Footwear Association warns of layoffs across 12 states as import costs rise and inventories collapse. But the worst part? This economic gut punch isn't accidental. It's calculated. And what China plans to squeeze next could grind entire U.S. industries to a halt. This wasn't tit for tat. It was theatrics with intent. By targeting politically sensitive exports, Midwest agriculture and Gulf Coast LNG, Beijing directly undermined Trump's electoral base. According to economist Alicia Garcia Herrero of Natixis, Xi's tariffs weren't economic. They were symbolic. The timing? Days before Trump's re-election rally in Iowa. The message? China can hurt where it counts, without firing a shot. In 2023, China bought $13.6 billion in U.S. farm goods, a figure that just became a bargaining chip. Xi isn't just sending a message to Washington, he's signaling to BRICS, ASEAN, and the EU that Beijing can weaponize trade without isolating itself. The twist? China's next move isn't tariffs, it's critical minerals. And this time, the pain will hit America's tech and defense backbone. In early April, China's Ministry of Commerce confirmed it would begin enforcing new export controls on rare earth elements, including gallium and germanium, materials essential to chips, magnets, and military optics. The U.S. imports 78% of its rare earths from China, according to the U.S. Geological Survey, making any restriction catastrophic. Already, Tesla suppliers have reported delivery delays, and Lockheed Martin's F-35 program faces shortages that could disrupt production schedules. This is a surgical strike, says Mark Fasto, former Pentagon advisor. We've known this vulnerability for 15 years and did nothing. With only one fully operational rare earth processing plant in the U.S., MP Materials in California, the scramble has begun, but experts at Brookings warn that scaling domestic capacity could take 3 to 5 years. In the meantime, green energy and defense budgets are bracing for impact. On April 3rd, Beijing blacklisted 5 U.S. defense contractors, including Northrop Grumman and Raytheon, banning them from exporting, contracting, or operating in Chinese territory. At first glance, it's symbolic. These firms don't sell to China, but underneath, a landmine. Many of their subcontractors depend on Chinese-made specialty metals, circuit components, and tooling equipment. According to a RAND Corporation analysis, nearly 18% of the Pentagon's Tier 2 suppliers rely on Chinese inputs. The blacklist also bars these firms from indirect commercial channels via Hong Kong, Macau, and ASEAN subsidiaries. cutting off access to dozens of previously gray zone suppliers. Analysts like CSIS's Emily Kilcrease argue this is part of a broader gray decoupling, where China isn't just reacting, it's proactively unspooling the U.S. defense industrial web. And if Washington retaliates with export bans on advanced chips, Beijing already has an answer: a blacklist of U.S. tech firms quietly being expanded in Shenzhen. Boeing just lost its seat at China's table. After U.S. lawmakers threatened to ban Chinese airline purchases of Boeing jets, Beijing responded by freezing all new orders and directing state-owned carriers toward Airbus and Comac. According to Reuters, Airbus deliveries to China surged by 37% in the first quarter of 2025, while Boeing's fell to just 19 aircraft, down 46% year over year. The real threat, however, comes from Comac's C919. Though still in early deployment, China Eastern Airlines plans to scale its C919 fleet to 150 jets by 2027, bypassing Boeing's narrow-body market dominance. Richard Abalafia, aerospace analyst at Aerodynamic Advisory, says, "If Boeing loses China for good, it's a $10 billion annual loss that can't be offset in Europe or Latin America." And here's the sting. Many C919 components are still U.S. made. But if China completes vertical integration, Boeing becomes irrelevant in the world's fastest growing aviation economy. And Wall Street is starting to price that in, with Boeing stock down 22% since February. The markets aren't reacting, they're recalculating risk. After China's retaliatory tariffs hit on March 27th, the S&P 500 slid 3.2% in 48 hours, wiping out nearly $1.5 trillion in market cap, while the tech-heavy Nasdaq posted its worst single-week performance since May 2022. According to Bloomberg, Trump's decision to reinstate and expand tariffs, now covering over $320 billion in Chinese goods, has triggered investor flight from key sectors: consumer electronics, agriculture, and auto manufacturing. Citi's chief economist Nathan Sheets warned in a client note that the administration's maximum pressure approach is cornering both economies into stagflation. U.S. importers are passing costs downstream fast. Walmart reported a 6.5% increase in supply chain expenses in the first quarter of 2025. With CEO Doug McMillon warning of accelerating pressure on low-income consumer spending. So the question isn't whether Trump miscalculated. It's whether there's any viable off-ramp left before voters start punishing the pain. The fuse is short, and it's already burning. China's central bank has quietly reduced its U.S. Treasury holdings by $101 billion since the second quarter of 2023, according to Treasury International Capital data. That leaves China with just under $711 billion in U.S. debt, a 14-year low. The real concern isn't mass liquidation, which would hurt Beijing too. It's the signal. Goldman Sachs warned in a March 2025 brief that even minor but sustained sell-offs can cause yield spikes as foreign buyers hedge against geopolitical risk. The 10-year Treasury yield jumped to 4.75%. Its highest since October 2023, following rumors of a People's Bank of China shift toward euro and gold-backed reserves. China also added 12.2 metric tons of gold in February alone, marking its 17th consecutive month of reserve diversification per the World Gold Council. According to Zoltan Pazar, ex-Credit Suisse strategist, China doesn't need to dump treasuries. Just de-dollarizing new reserves is enough to alter global capital flows. And with BRICS nations watching closely, this might not stay a one-player game for long. We've crossed the Rubicon. In 2024, U.S. China trade volume dropped to $514 billion.